Welcome. Today we're tackling something absolutely vital for anyone in finance, and especially crucial if you're prepping for CFA Level 2, measuring and managing market risk.
That's right. We want to help you get a real handle on how market swings can affect a portfolio.
And crucially, the tools professionals actually use, day in, day out, to manage that risk.
Exactly. We'll start with the value at risk VAR, which everyone's heard of, but it's often a bit fuzzy.
Okay, yeah, let's unpack VAR. It gets thrown around a lot. What is it, really? Is it the most you can lose?
That's the common misconception.
Yeah.
No, VAR isn't the absolute worst case scenario. The fascinating thing is VAR is defined as the minimum loss you'd expect.
Minimum, not maximum.
Precisely. The minimum loss expected a certain percentage of the time, say 5% over a specific period, like a day, given certain market assumptions.
So like a 5% daily VAR of, say, 2 million euros.
Means you'd expect to lose at least 2 million euros on about 5% of trading days. Maybe once a month, roughly. The real danger often lies beyond that VAR number.
Okay, that's a critical distinction. So how do we actually calculate it? I know there are a few main ways.
Yep. 3 core methods, generally. They all start by breaking the portfolio down into its basic risk factors, like equity indices, interest rates, FX rates, that sort of thing.
Right.
First up is the parametric method, sometimes called variance-covariance. It's often the simplest.
Because it assumes things follow a normal distribution, right? The bell curve.
Exactly. You use expected returns, standard deviations, correlations, assumes normality. Quick, easy for simple portfolios.
But the catch.
Well, real-world returns, especially in a crisis, often have fat tails. They don't always fit that neat bell curve. So parametric VAR can underestimate risk, especially with things like options.
Okay, so method 2.
That's the historical simulation method. This one's quite intuitive.
How so?
It doesn't assume any distribution. It literally takes your current portfolio and reprices it using the actual historical changes in risk factors from a past period, maybe the last year or two.
So it uses what actually happened.
Yep. Its strength is capturing real past events, even weird ones, without forcing them into a normal distribution.
Downside.
The past might not repeat, right? If the future market environment is fundamentally different, historical data might not be the best guide.
Makes sense. And the third one, Monte Carlo.
Monte Carlo simulation. This is the most powerful and flexible method.
Like running thousands of possible futures?
Kind of, yeah.
Yeah.
It generates many, many random potential outcomes for the risk factors based on statistical properties you define. You're not limited to historical data or normal distributions.
So you can model complex stuff, non-normality?
Precisely. Great for complex portfolios with derivatives. The drawback, it's computationally intensive. It takes time and processing power. And its accuracy really depends on how well you specify those initial statistical assumptions.
Got it. So basic VAR gives us that minimum loss threshold. But what about the risk beyond that point, the real tail events?
Excellent question. That's where extensions come in, like conditional VAR or CVR. Some call it expected shortfall.
CVR, what does that tell us?
If VAR is the threshold, CVR tells you the average loss you can expect if you actually breach that VAR threshold. It focuses specifically on the severity of those tail losses, much more informative about the worst-case scenarios.
Okay, that sounds useful. Any others?
Yeah, there's also incremental VAR, IVAR, that tells you how much adding or removing a specific position changes your total portfolio VAR. Very practical for traders.
So like the marginal impact of a trade.
Close. That's more marginal VAR, MVR, which looks at the effect of a very small change in a position. IVAR is for adding or subtracting a whole chunk. Both help manage position sizing.
Right. Beyond VAR and its cousins, what other risk measures are key? You hear about sensitivity.
Absolutely. Sensitivity risk measures are fundamental. These tell you how much a security's price is likely to change if one specific risk factor moves.
Like beta for stocks.
Exactly. Or duration and convexity for bonds, their sensitivity to interest rates. For options, you have the Greeks: delta, gamma, Vega. Sensitivity to price, rate of change of price, volatility.
But these don't give probabilities, right? Just the what if for one factor.
Correct. They measure sensitivity, not likelihood. Then you have scenario risk measures.
Stress tests.
Pretty much. Estimating portfolio performance under specific, often extreme market conditions. Could be based on historical events like the 2008 crisis, or completely hypothetical what-if scenarios. There's even reverse stress testing.
Which is?
You work backwards. What scenario would actually cause our firm or this portfolio to fail? It helps uncover hidden vulnerabilities.
Okay, wow. Lots of tools. How do firms actually use all this? How does it translate into day-to-day risk management?
It's all about setting limits and making smart capital decisions. They use constraints.
Guardrails, essentially.
Good way to put it. Things like risk budgeting, allocating the firm's total risk appetite down to different desks or strategies. Position limits to stop putting too many eggs in one basket.
Makes sense.
Scenario limits cap exposure to those extreme events we talked about. And stop loss limits, which are automatic triggers to cut a position if losses hit a certain point.
So these measures directly guide how much capital gets put where.
Absolutely. They help ensure capital is used effectively, supports the firm's goals, but crucially protects against unacceptable losses, especially those tail risks.
Fascinating. And I guess different types of institutions focus on different measures depending on their business.
Definitely. It varies a lot based on leverage, regulation, what they're trying to achieve.
Like banks versus asset managers.
Right. Banks are highly leveraged, regulated heavily, so they focus intensely on capital adequacy, VaR, economic capital calculations, rigorous stress tests, liquidity gaps.
Makes sense? Asset managers.
Asset managers, especially long-only ones managing money against a benchmark, are often focused on relative risk. So things like ex-ante tracking error, how much are we likely to deviate from the benchmark? Plus, position limits, scenario analysis.
What about pension funds? They have long horizons.
Exactly. Pension funds are all about asset liability matching. Can they meet their future obligations? They look at things like surplus at risk.
And insurers.
Insurers are a bit of a mix. Property and casualty insurers worry about catastrophic events, so they look at capital at risk from big disasters. Life insurers are more like pension funds, asset liability matching, stress testing market factors, but also non-market ones like mortality rates.
It really shows there's no single magic number for risk.
Not at all. It's about building a comprehensive toolkit, understanding what each measure tells you, and importantly, what it doesn't tell you.
A truly robust approach requires using them in combination, understanding the strengths and weaknesses of each.
Precisely. That combination provides the foundation for sound financial judgment. So, as you continue your studies and move into practice, the real question is, how will you weave together these different threads, these diverse risk perspectives, to navigate the markets effectively? Keep digging deeper.